Hey everyone, and welcome to Liquidation Day. Liberation Day. You know me, on days like today, I had to start the episode with a little bit of humor to calm down the nerves a little bit. And that's basically the topic of this video, to calm down the nerves. Because I will show you a couple of data points that show you what has happened in the past. Again, what has happened in the past might not happen today. Okay? Just so we're clear, some things that happened 50, 100 years ago, 20 years ago, happened then might not happen today. What is very similar is human behavior. So you and me, we are still human, we have emotions, and usually on days like today, emotions run high, right? We don't know, where our portfolio is down 5%, some stocks are down 10%, 15%, I don't know what to do, maybe I'll sell because maybe it can go down low. These things during days like today, usually what I like to do is I go out for a run, bicycle, it's a beautiful day today, sun, blue skies. And then you come back and you say, okay, maybe I don't want to do anything, right? Because if you're in front of your screen throughout the whole day and you see the market going down, everything is red, usually what happens is you make the wrong decision. Usually that's the case, right? I'm not looking at data here, I'm looking at human behavior. Humans during times like this, it's always very easy to be negative. It's always very easy to be skeptical, and then you make the wrong decision. We're always looking at, how defensive can I be? It's just how we're built, right? It's just how we are built. Now, I will show you again a couple of data points that will show you that things were bad before, that if you zoom out more, you'll see that even in worse situations, things were okay afterwards. Now again, today specifically, it's not a great day in the stock market, right? That's maybe an understatement. We have Google that's down 4%, Meta down close to 8%, Nvidia 7.4%. Apple, finally maybe Apple is starting to look a little bit cheap. Well, cheaper than before, it's down 9%. You've got actually the traders, I think it's down 10% or something like that. So plenty of stocks are down a lot, even if those stocks, those companies are not going to be impacted that much by tariffs, right? A lot of these software names will not really be impacted that much by tariffs, and a lot of them will not be impacted, period. At the moment, semiconductors are not really getting impacted by the tariffs directly. Indirectly, you could say that these companies might, right? Okay, but at the moment, that's not the case. So yeah, today, looking at all of those names, in my opinion, of course, it is showing you, plenty of great companies that are trading at great prices. Because if we're not going to take the opportunity, if we're not going to look at an Amazon, for example, or a Google at these prices and say, okay, great company trading at a good price, then when are we going to look at it, right? When, we can see that the trend line on a technical analysis part, the next support level, we are buying companies here. We're not buying candles on a chart. Just so we're clear. Of course, if you're a trader, you probably love these things, right? High volatility, things go up and down. If you're an options trader, maybe not so, especially not if your options are expiring anytime soon. Long-term investors are probably looking at all of these names and are like, actually, maybe I might start to add even more to these positions that I already have. Or maybe I might say, actually, this company has now become much cheaper than I thought it would. Maybe it's time to open a position. Now, me personally, I will just continue to add to the existing positions that I have. And by the way, we are going live 12:30 Eastern. As always, we're live with Jose and myself. You can ask us anything and we'll provide, hopefully useful information. Now, let's go over a couple of data points and start building a story here, because it's always important to have a story, but a story that is backed by data. A story that is not backed by data is just, BS. So if we look here at the index that basically tracks or shows the percent of bears versus bull, or bearish sentiment, bullish sentiment, we can see that right now we're at 61.9%. The last time we were this high or higher was the 2009 market bottom. Market bottom, very important to note. Now, previously, if we look at what has happened to the S&P 500 after that bearish sentiment, that percent was above 61%, you can see, and it only happened twice. It happened in 2009 and it happened in 1990. But you can see that 1 week later, you're up. You're basically up from here. That's what has happened in the past. But of course, these are just two things to look at. So let's not make a generalized, opinion here just based on these two dates. But we can also see that right now, these are 6 consecutive weeks of above 50%. And that only happened once back in the 1990s. That was 7 consecutive weeks where this sentiment was above 50% bearish. Now, like I said before, 2 data points. So let's look at way more dates. So here, what you're seeing is basically the S&P 500 hit a 1-year high last month. So in February, in our case right now, February, but closed down more than 5% in our case, March or the month after that. So these were all the dates here. Now let's look at the first week, 2 weeks, 1 month, 2 months later. We can see that the times where we actually were green, 1 week later, 67%. 2 weeks later, also 67%. Then 1 month later, 73% of the time. 2 months later, 67% of the time. What happened afterwards is even better. 87% of the time, 3 months later, we were green. And after that, 6 months later, 9 months later, a year later, 100% of the time we went green. So let's say in the short term, a lot can happen, right? It's always in the short term, there's always volatility, there's always uncertainty. Now, let's flip it. Let's say we are negative, we are bearish. So let's flip it. Okay, we might be, a week later, we might be in that 33%. With 33% of the time, we were in the red still. Okay, that might happen. 2 weeks later, might also happen. A month later, 27%. We're in that 27% bucket. That might happen for sure. It's always a possibility. Remember, a month from now, we're going to the earnings report. Now, earnings report, Q1 is already over, was over before the April 2nd announcement. So all of that impact is behind us. So a lot of the expectations and the focus will be on, of course, guidance. Now, remember what I said before. The dollar being weak or weaker is going to help a lot of companies that generate revenue outside of the United States. Think about the Mercado Libres, think about the Amazons. These type of companies generate a lot outside of the United States. And that's why their guidance got hit by FX headwinds. Those FX headwinds can turn into a tailwind as the dollar gets weaker. Now, of course, if we go into a recession or maybe even worse, stagflation for the next 6 months or maybe even more, 9 months, it's not going to be great for these companies. But if we look at past events, worse events, right? Way worse events. World War I, World War II, influenza, Cuban Missile Crisis, Great Depression, you name it. What can you see here? It's pretty clear. The US stock market goes up and to the right. Okay, there are some periods where, yes, here, for example, here, a lost decade. Here you have also a long period where things are getting worse and worse, and basically the stock market did nothing for a long period of time. And so, yes, it's true that sometimes what I say might not resonate with you because I'm young. I'm turning 31, so I still have a long time left ahead of me. Well, hopefully, right? I'm touching wood here. Maybe it's not wood, it's actually granite, but okay. I still have a long time left normally in the stock market. If you are 60, maybe 50 or something like that, then of course the story is a bit different because you don't have that much time left until you retire, for example. Then maybe once you reach 65, you're like, okay, I want to look at my portfolio and I want to live off those gains. And by the way, even when you retire, I still think that you need to stay invested. And yes, maybe you can use some of the gains to relax and enjoy life. But me personally, I see this and I'm looking, okay, great opportunities. If I zoom out, we've had worse periods. If I zoom out, we go up and to the right. And if you think that the US is going down from here, I have a bridge to sell you. And as I've shown you in past videos, if we are looking at recessions, right? If we are going into a recession, by the way, a recession, 2 consecutive quarters of negative GDP growth, which means even if we have 1 quarter of negative GDP growth, that's 3 months. We need 6 months to really know if that's happening. Even if there is 1 month, as we've had that in 2022. It's not enough to call for a recession, by the way. But let's say we have a quarter where GDP comes down. Okay, where it's negative. What has happened in the past is, as you can see, the stock market bottomed before the recession is over. Even with the Cuban Missile Crisis, as we've discussed that in past videos, the stock market started to recover its losses before the event was over. And here as well, you can see the X's here. Those are the bottoms.
Bottom. Hilarious.
And you can see that the bottom is happening before the recession is officially over. Last couple of things here. One, you might say that the main goal of all of this is to make sure that interest rates will come down. We can see here the 10-year yield at the time of making this video is now very much close to 4%. Now, all of this might lead to the Fed cutting rates faster than expected. If rates are coming down faster than expected, then the US can refinance the trillions of dollars in debt at lower rates, which would make sense, which would basically save them a lot of money. In my opinion, and of course I can be completely wrong, but I think that's the goal. The goal here is to refinance a lot of the debt, and there is a lot of debt to be refinanced this year at much lower rates. And then if that happens, or when that happens, then things can change quite drastically, quite fast, especially in the stock market. Now you might say that you don't know what you're talking about, this doesn't make any sense, etc., etc. Fine. Again, I have no issues to admit that I was wrong, but let's see how these things play out. By the way, even the biggest economists here on the planet have been wrong many times before. If you have a crystal ball to sell me, I'd sell all of my possessions and buy that crystal ball. Unfortunately, that doesn't exist. So we're here to make educated guesses, predictions, what's going to happen based on data, right? Because if you're not basing your predictions or your assumptions on data, then what's the point here? What's the point? But to also go back to the, let's call it 2022 versus 2025 type of example, I would say, to me, it doesn't make any sense. In 2022, we're just coming off, huge money printing years, right? Inflation is going up extremely rapidly. Interest rates are going up extremely quickly as well. Today, that's not the case. If you're looking at trueflation, that's coming down quite rapidly. If you're looking at interest rates, that is also coming down. Maybe not as fast as expected, but it is coming down. So in 2025, in my opinion, to flip or to switch here the sentiment, especially in the stock market, is much easier than in 2022. Because in 2022, there were companies that were not profitable, and even those that were profitable, those were trading at ridiculous prices, right? A 50 PE was normal. It's not normal. But today, we are in a much better position. If you look at specific companies, if you look at great companies, they're trading at extremely cheap prices. Now, of course, there are some people that will always want it to go lower and lower and lower. Fine. But I think today, in my opinion, if they say, the administration says, okay, we've reached our goal, we've refinanced the debt, it's good enough for us, it's much easier to suddenly change the sentiment. And when sentiment changes so rapidly, a V-shaped recovery can happen in the stock market. It can. I'm not saying it will, but it can. So in days like today, me specifically, what do? Well, sometimes I do nothing. The other times I just keep adding to positions that I have. I don't have unlimited amount of cash. No, I have cash. I can always inject more if I really need to. But I've seen the prices. The prices are not that different than what they were on Monday or a week or so ago. So I have time. That's the luxury that a lot of us have here, and that's time. So to end this, although many people want to, scare you, say that this is the end, the Great Depression, the Great Crash, the Great Reset. No, sorry, but I don't see that happening. And maybe I'll be wrong, but to be honest, I think people got way more depressed when they were locked in, when they could see their family and friends. Today, I can do whatever I want. Okay, I can go work, I can go open my store if I want to. Nobody's telling me that I cannot do that. So sorry to say to the great depressionistas out there, but this is not the same. So all in all, breathe, keep calm, look at the long term, look at great companies. Now is definitely not the time to start playing around with speculative names. I'm being very honest here. Now it's not the time to looking at speculative names. Now is the time to start buying great, solid, profitable companies at very, very good prices. We're going to talk more during the live stream, so make sure you're going to join us there. Hit all the buttons. We'd really appreciate that, especially the subscribe one, and I see you all in the next one. Bye-bye.